G'day, I'm Jonathan Bayes. This is Monday the 11th of June and some thoughts on investment portfolios as to how we see things. We're in that really weird intermediate twilight period where markets are really optimistic about the future, but the data continues to weaken. Certainly in Australia that's the case. There is reason for being more optimistic on the Aussie economy into 2020. The tax cut package might even get brought forward if you believe the press and Labor's support for bringing forward those middle income tax cuts. The interest rate cut helps from a sentiment standpoint, but probably doesn't put a huge amount more in people's back pockets. But in the interim, it's because the economy is really weak that we're getting the tax cuts and getting the rate cuts. And last week, the construction sector data continued to weaken further. The Purchasing Manager Index for construction was further deteriorated. The building approvals numbers very, very weak. We had the GDP figure out, which gives us a great guide for the local economy, growing at an annual rate that we've not seen in the better part of a decade at 1.8%, so very poor. And in actual fact, on a per capita basis, the Aussie economy is already in recession. We've had 2 negative quarters of growth. So it's a bit of a struggle. The ANZ job advertisement numbers plunged in May, and again, I'm sure part of it's federal election related, but down almost 15% year on year, and if they were to continue, would point to 50 to 100,000 sort of full-time jobs lost in the next 6 to 9 months, which goes completely against the grain that we've seen of late. So this week's unemployment figures will be a really big focus. I'm concerned in the coming couple of months that we are going to get some negative figures coming through, and that we may well get a bit of a dose of reality. We're also going to get Westpac and NAB, Westpac Consumer Confidence and NAB Business Confidence figures this week. Hopefully we'll see a little bit of a rebound in sentiment post the election. And the US is no different, in that we're not miles off the highs, but yet we've not seen in the data anyway a significant weakening in the US or US economy in particular on account of the trade issues. I feel that that's coming. Markets didn't react too negatively again to the antitrust probe that was announced last week into Google, Amazon, Apple and Facebook, and yet I think that they probably should be a little concerned. So it's a bit of an interesting market where it seems to be that the deteriorating fundamentals are being put to the side and that the positive narrative is really driving things. So let's wait and see how that goes in the coming couple of weeks, but we retain the caution. We feel it's the only way to be. There's a lot of stock news out last week. Afterpay over the weekend has been reported are going to have capital raising. Their business update last week was largely in line with forecast, but interestingly, for the first time in a while, didn't get to the bullish analyst forecasts. So a little bit of a reality check coming in that Afterpay is now growing in line with the market, which probably brings about a bit of a derating. Regis had a profit warning disappointingly last week. They're being squeezed on margins there as wages are going up, but occupancy is a little bit weaker. We really need to work out what to do with our Regis position because it has been disappointing. Telstra starting to creep up to levels where we think it's probably right to start reducing. There are a couple of stocks that turned up in the market that we're very close to adding to. Costa Group not quite there. Reliance Worldwide's another one. So opportunities are emerging, and actually just 2 really quick interesting anecdotes from us, which I think sum up our market at the moment. Momentum versus value. Magellan and Pendal Group. Broadly, Pendal has a larger funds under management, similar revenue line, but it trades a quarter of the value of Magellan at the moment. And IWF and Net Wealth. IWF is worth 20% less than Net Wealth, yet it has twice the funds under advice and a desperately profitable still advice and funds management business. But as I say, trades at 20% discount in value terms to Net Wealth. So I think there's some great opportunities are starting to emerge along those lines. Hopefully we can take advantage and exploit them in the coming couple of months. Thanks.